Good afternoon or good morning for our folks on the West Coast. Thank you for joining us for today's 2026 webinar series. We appreciate you taking the time out of your busy day. Before we begin, I'd like to note that this webinar is being recorded and that all presentation materials will be posted on our website. If you would like to ask a question, please use the Q&A feature, and if time allows, our speakers will jump into it at the end. At this time, I will allow our speakers to introduce themselves and thank you for being here today.
Well, thank you for having me. I am Lene Light. I am a principal at Witham. Um, Witham is a top 20 CPA firm, and we work with government contractors, specifically 8A contractors in the compliance landscape.
Yeah, and I'm Cy Alba. I'm a partner at the law firm at Polaro Mazza, and we represent mainly federal contractors of all sizes, with basically most of their legal needs. And I've been doing government contracts for about a little over 20 years now, and we do a lot of small business work as well. So we're going to kind of kick things off here and talk about a number of different things dealing with 8A M&A transactions because they can get pretty complicated, and we'll go back and forth here on these various issues. So kind of kick things off because it's a short time frame. I wanted to start with some of the transaction types and how things can be done. And this is important, especially for 8A, because there are different rules we'll go through in a little bit later, depending on the type of transaction. So you might hear stock deals or equity deals, which is where you sell the entirety of a company, including the entity itself. And then you have things, an asset transaction where the entity might continue to exist, but for some period of time, but all of the assets, which can include contracts, tangible and intangible assets, and all that stuff, is sold to a third party. And then you also have things like investments or financing rounds, convertible debt, things of that nature, where it's not a complete sale, but where someone comes in and they buy a portion, usually of the equity. But again, it can take other forms. You can come in and loan money, and convertible debt is something where you give someone a loan, and if the loan is not paid, then it converts to that amount of equity that's commensurate with the loan amount, usually at the time the loan is made. And so that can be done in certain ways. And the other thing I'll note too is with asset transactions, in particular with 8As, they're very difficult because you need, and in either case you need SBA approval, but in particular with asset transactions, there's been a lot of pushback recently on selling 8A contracts and moving 8A contracts around, so that's become particularly difficult in the 8A space.
Yeah, and what I will add too about novating a contract is that you do have to get approval of the contracting officer before you can have the contract novated. And if it's not approved, the original contractor still remains fully liable for performance on that contract. And then failure to perform can result in termination for default.
Yeah, exactly. Exactly. It's a very good point. Um, and so a lot of times what I hear from folks too is that the reason they're looking to do something is to really acquire past performance is pretty common. And I think there's a misunderstanding in a lot of folks' minds about the idea of buying contracts and getting the performance that former company made on that contract, especially when you have what I'll call like almost dead contracts where maybe it was a big IDIQ, there's not much work on it anymore, or it's end of life, and you can get a good deal. And folks, I think, misunderstand that they think that they can buy that and then get the experience in past performance. And that's really not the case. If you're challenged on that at the GAO or Court of Federal Claims in a bid protest, you need to prove that there's a nexus between the performance on the contract and what you did, right? And if there is no such nexus because you just bought the contract with no work on it, then you're basically going to lose that protest. And so I think it's very important for folks to understand that as a major point. But also, trying to get new revenue sources, access to new agencies, and get potentially new lines of business or management teams too, if you're doing some sort of merger or something of that nature. So there's a lot of different reasons why people do these things. Um, so yeah, do you want to kind of walk through? Maybe you take the lead here and walk through some of the valuation pieces here.
Sure. So valuation, we always start with EBITDA, and that's your earnings before interest, tax, and depreciation, and amortization. Though the EBITDA is really your true operating profit, right? Um, when you add back the depreciation and the amortization, that's what you end up with, your true operating profit. And so a lot of times we look at EBITDA, but then we also look at just the operating profit in order to determine just the overall value of the company. And then, once EBITDA is established, buyers often talks in terms of like multiples. And, those multiples can vary in a GovCon. So multiples on top of your EBITDA or your what I like to say operating profit, also shortened here as EBIT.
Yeah, and I think if like rough orders of magnitude, you'll often hear folks say, well, for like a small business, it's 3 to 5 times EBITDA, the value of the business. For 8A, I think it's probably lower. Sometimes it's even like 1.5, 2. Just because there's so much difficulty in buying and selling 8A contracts and 8A companies because of some of the approval that's required from SBA. But I think as I had here on this slide, if you got more and more full and open work or vanilla small business work, as the buyer pools get larger, then the potential is larger for the value of the company. And this doesn't take into account intellectual property, things of that nature, because that can just blow this. It has nothing to do with EBITDA. It's like a completely different analysis. And I've certainly seen clients sell particularly valuable IP in and of itself for more than what the company is valued otherwise. So just kind of
Right.
be aware of that.
Yeah, so like just having 8A work, is going to lower that multiple. It is important to diversify outside of the 8A program. And that's really the purpose of being within the program. It's a business development program to help you grow as a small business, not just grow within the 8A space, but grow in the full and open competition space, as well as commercially with B2B. Another thing that's to consider when looking at the multiple, especially for a government contractor, is your compliance program. Do you have compliant business systems? Are you having audited financial statements performed? Do you have a CMMC certification? And these are things that a buyer is going to look at to help determine what the multiple would be.
Right, exactly. Um, and then other things to kind of think about, especially if you're looking to buy, but if you're looking to sell as well, knowing that there's a lot of, and I think a disproportionate number of federal contractors, especially small companies, tend to be S corps as opposed to the rest of the world, uh, is what I see. And that can be difficult because if you're an S corp, which means you have an S election, so you could be an LLC, tax as an S corp, you could be a C corp, tax as an S corp, um, and if you've made that election, there's all kinds of restrictions that you have on the structure of your company, the way equity can be held, the types of shareholders you can have, things of that nature. And so if you need to restructure, and there's this thing called an F reorganization where you essentially put a holding company above yourself in order to convert your company into a Q sub, which is just a tax designation, and to allow you to then take investment in the holding company that's an LLC. And if people want to kind of get in the weeds, we can talk about this offline. But that it's a way to restructure yourself in order to avoid tax implications or negative tax implications. But by doing that, you essentially make yourself ineligible for a number of programs because you're no longer held, your entity is no longer held directly by the individual. It's held by that holding company, which is a violation of the 8A rules, the woman owned rules, and the SDVOSB rules. You can do it as a hub zone and a small business, but not for the other programs. So just be aware of that as well, that you can run into certain tax issues. There are other ways around it, like grossing up the purchase price and things of that nature as well, but just something to be aware of. When you're looking, if you're looking to buy, or also if you're looking to sell, you should be aware of your own potential issues. Um, if you've had problems with compliance, right? Or if you form joint ventures or you've been in the 8A program, especially if you think you've kind of skirted lines here and there where maybe subcontractors were doing too much work, which is becoming more and more of an issue right now. There's a lot of investigations going on, or if you're a hub zone firm and you were moving folks around from other companies or other subcontractors in order to meet compliance requirements at the last minute or things of that nature that put you in gray areas, those are definitely things to be aware of. If you have a potential buyer that when they buy you, they might have OCI issues and conflict themselves out of what they're bidding, or if someone's going to buy you and conflict themselves out of work you plan to go after, that can impact the value of your business. Realizing that if you've got like a GSA schedules, there are other things that to get involved there too, where it can be difficult to kind of merge schedules and handle ongoing task orders, data rights questions, like you think you own certain intellectual property or you have, or the government only has limited rights but you didn't protect it appropriately under the 227 clauses in the FAR and DFARs. You see that all the time. If you have cost and pricing problems, a lot of cost reimbursable contracts, it's very complicated. So there's just a lot of different issues that you need to be aware of when you're looking at companies in the federal or state space where, or any sort of highly regulated area. And if you're selling, you need to be aware of your own warts as well.
Yeah.
Yeah, were you gonna?
Oh, I was going to say, yeah, I agree with all of, what you said, especially if, as a buyer, definitely doing your due diligence on the company that you're buying, looking into their CPARs, looking if they have cost and pricing data issues. A lot of that is, issues in their compliance program. So look at what do they have documented for their compliance program. Do they have a letter from DC from their contracting officer, uh, approving or accepting the systems that they're using. These are things that can come back to bite you later, meaning especially if you don't have like the acceptable system and you're going out to recompete or a modification is being issued, and now the contracting officer has to look back at those deviations that they saw within the system, and those can actually prevent, your contracts from being awarded. So it's very important to do the due diligence as a buyer, and then as the seller that you are constantly monitoring and doing due diligence within your business practice in order to remain attractive to a seller.
for sure. Um, and you know, particularly for 8A companies, is sort of what I alluded to before. It used to be the case that if you were buying and selling a 8A contract or assets related to an 8A contract to include the contract or the equity in an 8A company, SBA had to approve that through the waiver process under 124.515. That's kind of no longer the case in certain respects. So SBA, while the regulations and the statutes have not changed, they've changed their interpretation of the rules over the past couple of years, such that if you're buying and selling the equity in an 8A company, they do look at it as though it's not really a waiver that's required under 515, 124.515. It's instead a substitution of an 8A, one 8A company for another 8A company in the perfect example under 124.518. And so because of that, it's become a little more difficult or more confusing, especially in the current environment where a lot of folks who had the interpretations changed the interpretations. A lot of folks in the legal office at SBA are no longer there. And we worked pretty closely with some of the folks in the Office of General Counsel at SBA to kind of figure out the best path to get through these different new interpretations. And now all those people are gone. So you're dealing with a situation where you have new folks that don't completely understand things. You're probably going to hear different things from different business opportunity specialists, your 8A BOS, and a lot of times they're wrong. I've done many presentations with folks at SBA that are brand new, and they're getting things wrong and providing incorrect data. So just be aware of some of these issues. If you're buying and selling 8A contracts, you still need to go through the waiver process. The waiver has to be submitted before closing. You don't have to wait for the waiver, but if the waiver is denied, that's a waiver for the termination for convenience clause. SBA will send a letter to the contracting officer saying the contract needs to be terminated. For a substitution, generally speaking, SBA will not allow the 8A one 8A company to be purchased by another 8A company, merger or otherwise, without the buyer being an eligible 8A company. And to a question that we got that could fit in here, if you are buying a former graduated 8A company or another current 8A participant, if the value of the assets of that business are more than 50% of the combined entity of you as the buyer and them, you will be considered a successor in interest for 8A purposes to that company. And you could be early graduated or become ineligible because of that. So if you're buying a company that's valued at, that has market value, and that's determined under totality of circumstances, which I know is kind of an unhelpful metric, but because it's in the eye of the beholder. But if you do that and their value is more than 50% of the combined entity and they're graduated, you will likely be graduated yourself. So you need to be very careful if you're taking on that. Also, we're dealing with a number of investigations right now, some that are extremely public that you've probably heard of, where the limitation on subcontracting has come into under the spotlight. I've also dealt with a number of mentor protege fraud cases in the past, especially in the construction industry, where the Department of Justice believes the program has been used as a vehicle for fraud. And also that's under the microscope as well. And then when you have joint ventures that you've done, the performance of work rules there are very complicated or can be very complicated, especially on IDIQ contracts, where the joint venture members in the aggregate have to do 50% of the total contract dollars with their own W-2s, not 1099s, W-2s. And out of whatever percentage you're doing, whether it's 50%, 80%, with the members in the aggregate, the qualified member of the JV has to do 40% of that percentage. And the way the Department of Justice has looked at that is that if say the mentor company or the non-qualified entity, 49% owner, let's say, of the joint venture, is using or subcontracting, the JV subcontracting to an affiliate, that's counted as work inside the JV, which can then violate the 40% rule. So there's a lot of like nuance there that's actually not in the regulations or the law. That is just interpretations by the Department of Justice. So if you're looked at, it's just another thing to keep in mind and also something to pay attention to in the diligence phase. Um, really quickly, I think, as you're going through things and there's post closing issues, I think we've already mentioned you're going to have to go through the waiver process beforehand or the substitution process, but then afterwards, you got to go through the novation process. If you are buying assets or if you're merging and the other company's going away and becoming part of you, it's also going to require novation. But you also need to do things like updating SAM and going through and recertifying your size and status within 30 days of the transaction. Um, if you have a security clearance, facility clearance, you're going to have to do some additional work. If you're registered with DDTC, which is the Director of Defense Trade Controls for ITAR purposes, you got to go through that process as well. So there's just a number of things you need to make sure you're paying attention to as you're going through the post closing process as well. As noted, when it comes to recertifications, if you go through an M&A process, and you buy the stock of a company within 30 days of the closing, you have to recertify size and status. And as of January 17th at midnight of 2026, there's disqualifying recertifications and qualifying recertifications. If you are large or no longer eligible because of the transaction, then you for multiple award contracts, you will no longer be eligible for options or to bid new task orders under the IDIQ. Multiple award contracts. For single awards, you are eligible for options. You are eligible to get additional task orders under something like a SATOC, a single award task order contract. Um, and the other thing to note is that if you are a small business under the NAICS code applicable to a particular contract, and you were the buyer and the seller was small as well, and you go through a transaction, even if combined you are large, you will recertify as other than small. But even for multiple award contracts, you will still be eligible for options and still be eligible to bid task orders. But the agency cannot take the credit for the dollars spent anymore. But you don't need to tell them that. You just need to recertify. And a recertification can simply be an email. So just kind of pay attention to those particular issues as well. Just something to keep in mind. Another piece of this is that if you submitted a proposal within 180 days, or the seller submitted a proposal within 100, actually it's either party, within 180 days of the closing of a transaction, where you have a disqualifying recertification, where you're no longer small or no longer eligible, you have to tell the contracting officer, again with that 30 days, and you will not be eligible to receive the award. So that's just another thing to keep in mind to look at. And part of the diligence phase is if there are key contracts that are floating out there, you probably don't want to move forward with a transaction until those things have been awarded, so that you could potentially try to keep the awards. Otherwise, you will lose out on those and become ineligible to receive the award, even if you were first in line. When it comes to joint ventures, the joint venture member is the one that has to recertify. So if you're a mentor and a mentor protege, or if you're buying a mentor and a mentor protege, or if a mentor in a mentor protege joint venture is buying another company and has to recertify under its contracts because it has small business work, it will not impact the eligibility of the joint venture so long as the joint venture has been put together the right way. So I think that's an important distinction as well. So a lot of folks, if if they're already large, let's say, and they're looking to do some inorganic growth by buying other companies, to the extent that you can move contracts into mentor protege joint ventures where you are the mentor, you can go into a lot of M&A activity as a buyer or frankly as a seller, and the recertification as large for you will not impact the eligibility for the joint venture itself, which will keep a lot of extra value in there. And so that's money that the buyer will be able to sort of count on and not lose, as opposed to if you were just simply a prime contractor and it was like we said, a multiple award IDIQ contract where you might not be eligible for options or orders anymore. So if you're already large and you're looking to sell, it would be a good idea, and you're trying to maintain as much value as possible, it might be a good idea to kind of move things around or think about moving things around and running the numbers and seeing what might make the most sense as you're going through that pre-diligence process or pre-sale process.
Yeah, I would just add, for a JV, um, the JV itself, like if it's organized correctly, it doesn't follow the same affiliate rules. So and that's why um, you can still, the JV would not be affected, is because the affiliate rules are a little bit different for a JV.
100%. Um, yeah, and as we already alluded to, some of this, like the novation, there's a number of things that are required. Unfortunately, the novation process is very discretionary, and different contracting officers might be more or less of a stickler when it comes to the rules. So certain things like the document effectuating the transfer, whether it be a purchase agreement or a contribution agreement or whatever it happens to be, that's always going to be required. The novation agreement itself is always going to be required. But things like having uh, let's say, the corporate seal or a wet signature, things of that nature, some contracting officers still insist upon that, or audited financial
Mhm.
statements. The FAR requires audited financial statements, which is a very complicated process. I think we can kind of talk through, but when it comes to that, it's a good idea to kind of try to communicate with the contracting officer and see if they'd be willing to take either reviewed or even less than that, like something that's just put on the letterhead of the accounting firm, which they may or may not be willing to do. You can talk to that, Lene, or things about if it's just an internal document that your CFO or some person inside the company is willing to do, and then you just certify to it, things of that nature, to attempt to see if they would accept that. Otherwise, it's a pretty complicated process. I don't know if you've ever done truly like audited financials, because that's pretty complicated. But
Yeah, audited financials can be complicated, but honestly, the complexity, it comes from, how is the company organized? What is your structure? And, how well is your data, right? And how responsive you are with your auditors. Um, and then I would say, for an opinion, if you're looking for an opinion, you're most likely looking, it's a reviewed financial or audited financial. So you can definitely, request your contracting officer if they would accept reviewed financials. Anything less than a reviewed financials is not really going to render an opinion unless it's something like an agreed upon procedure or an examination. But honestly, if we're going down the agreed upon procedure route or an examination route, you probably might as well do the audited financials. For audited financials, it really depends on the size of the company, the structure of the company, um, and just how organized your data is. That's going to determine our level of effort when we're performing an audit. I would also advise, if you're thinking about doing an asset transaction, keep your contracting officer in the loop. Like talk to them from the beginning. let them know that this is in the horizon, this is what you're thinking about, and what your options are. Um, because you don't want to wait until after the sale has occurred and now your contracting officer is not going to approve a novation of the contract. So I would say keep them in the loop early just so that what is it that they're going to require? Will they give you a waiver of the audited financial statement? Is the contract able to be novated? Right? That would be the first question. And so keep them involved.
Yeah, that is absolutely critical. Great advice there, because I know things like Stars 3, for instance, very, very hard. The SBA and GSA have taken positions on some of those that they don't want to do it. They think there's too many people in the vehicle already. So just sort of being aware of that stuff. Um, and I think just to answer another question, I know it's time, but the idea of leveraging PE in your capital stack as an 8A firm, it's certainly possible. The issue there is that you're going to need SBA approval for certain percentages. So if there's a change, a 30% change of ownership away from the qualified individual, even if you're still owning the remainder of, like, let's say 70%, that's something that is going to need SBA's approval. And even if it's below certain amounts, you're going to have to give notice to SBA and they can look at that. So it's the way SBA has a lot of control over things and a lot of 8A firms and 8A contracts, because the 8A contract is actually between the agency, the awarding agency, and SBA, not the 8A firm. And the program is more highly regulated than anything else because it's specifically meant to be almost an agreement between the company and SBA. And so SBA then acts as the intermediary to the various agencies. And so almost everything you do as an 8A firm, you need like the mother may I from SBA. And I can tell you a lot of the rule changes that occurred last year that took effect in January with recertification is because SBA does not like the fact that private equity is getting into federal contracting, in particular, getting into small business work and 8A in particular. So they take a very a close watch on some of that stuff. And it's certainly something that folks do. I've worked with on both sides, the 8A company and the private equity firms, in order to take equity stakes. And there can be pretty interesting structures that you can put in place that are kind of gray areas that I don't really get into publicly because it's up to the business owner whether they want to take certain risks, but it's something that is possible. It's just something that you need to be aware that you might need SBA approval for certain things. So I know we're a couple minutes over, but I don't know if Lene, you wanted to kind of give any closing thoughts here before we wrap up.
Closing thoughts, if you're preparing for a transaction, I would say definitely engage with an expert to make sure that you are checking all the boxes. There are, many requirements that we talked about today, things that you have to have documented, have app forms completed. So ensuring that you're doing the full due diligence is very important in order for the transaction to be smooth and then also to prevent those roadblocks from possibly the SBA or the agency that you're working with. So I would say definitely, consult an expert when going through a transaction.
Perfect. I think thank you guys. Appreciate everybody kind of being on, and I know we went a little bit over, but if anyone has any questions, this is our information here, and I think the information will be shared. This will be posted and provided to folks. So appreciate it.
Yes, thank you so much for this information and the tips and the trips that you guys were able to share today. As they mentioned, we will be posting these on our website, nationalaidassociation.org. But you can always reach out to us if you have any questions or if you'd like us to connect you with the speakers. We would be happy to do so and pass your information along. And again, thank you to everyone who took the time today. We hope to see you at our next webinar series. Have a good one.